Well, why don't you have a look at this? Oh my gosh, okay, the day after Voyager goes and announces bankruptcy, there we are. A beautiful green day. NASDAQ up over 2%, Russell up over 2%, Bitcoin up 6%, Ethereum up 6%. Listen, I was a sacrificial lamb yesterday. From what I hear, basically, for every company that goes bankrupt, the next day we can have a very green day. So I was a sacrificial lamb this time. I need somebody else's company because I can't keep losing money like that, guys, or I'm not going to have any more money to lose. All seriousness, in this video, I got some really important stuff to show you guys. And the premise of today's video, and by the way, there might be a loud beast somewhere around here, so I apologize for that. But nonetheless, Daddy's on daycare duties right now. Okay, I got to make some side income, so I just take in kids from the neighborhood and take care of them and whatnot. It's side income, But in all seriousness, in today's video, what we're going to get into is essentially this thought process that's going on in the market right now, which is, if the market has a green day, everybody's like, they don't believe in it, right? People believe that things are going to continue to go down and go down. The market's going to continue to get worse. All stocks will be lower in 3 months from now than they are today, and 6 months from now than they are today, right? That is the common almost belief out there now. And it's obviously that's a dramatically different market than we're used to being in, because usually people expect the market to go up over time. And so when everybody's expecting, this downtrend to continue, it's for certain reasons. And the reasons are obviously recession fears, right? Earnings weakness potentially coming, and things like, well, everything's been going down, so why would you think it's going to be any different, right? We've been going down for like 8 months now. Now, a few things I want to get into that happened in the trading day today that I thought were interesting, and then we'll get into the big part of this video, which is addressing that, okay? But big tech, it was a great day out there in big tech world. Shopify, Uber, Tesla, AMD all made 5% plus upward moves. Obviously terrific day for big tech. Palantir's in an interesting spot here. Palantir in the last week or two is up 34%. This stock is moving and grooving. They haven't announced earnings or anything like that. This stock is just on a little tear here, right? And you couldn't get anybody to buy Palantir for the longest time. And now all of a sudden this stock is moving and grooving with very little market action. If you look at what the NASDAQ's done, the S&P 500 over this time, I should have pulled that up in a comparison here against Palantir. It's like nothing compared to the move Palantir has made. So something interesting is happening there. I bought this stock recently, and it's already up 27%. And obviously, if you buy a stock and it goes up that much that fast, you're like, why didn't I buy more shares? And this is interesting. Okay, here's why this is interesting: is this is a dilemma that we haven't had to deal with in the market for a long time, for at least 8 months now, right? We have not had to deal with the dilemma of you buy into a stock, the stock price shoots up a bunch, and you're in a position where it's like, do you average up now? If the stock's up 20, 30% in a very short amount of time, do you average up, buy more shares? Do you hold back? Do you hope it drops more and it drops back down to where you were buying at? Do you wait till it drops under cost basis if it does that, right? This is a dilemma we have not had in quite a while, right? Because everything's just been downtrending. So it's like if you bought a stock, let's say Palantir, right, is lower like a week later, or a few days later, or a month later, right? So this is an interesting kind of situation. The way I usually look at this is, if I feel a stock is still significantly discounted, I'll continue to buy that stock. Even if I got to average up, I'll usually continue to buy that stock. In Palantir's case, I'm not necessarily in a rush to buy more shares, just because there's a lot of other stocks that are obviously, unbelievably cheap out there right now. And that's the other thing you got to kind of always say is like, well, what if this other stock's really cheap versus this other stock, right? Banking stocks actually had an upward day finally. JP Morgan seems like it's gone down every single day for a while. Not today. It actually, had a gain with JP Morgan. So what do you know there? That's a stock I do own in my dividends only account. I might buy some more JP Morgan over time. Lumber in particular, I had a big upward day. We don't like to see that. We don't like to see what's going on in commodities today. We don't like to see this. Oats were up only a little bit though. Corn was up. Obviously, WTI was up. Wheat was up. The overall commodities index was up almost 4% today, and obviously lumber was up as well. We don't like to see that. Natural gas was down. Okay, that's good. But commodities having a big boom day like that. It's actually surprising the market had such a good day considering commodities were up big today. That just hasn't been the trend for a while now. Usually commodities up big means market down big. Market up big means commodities likely went down big. That's just not the situation today. It was just kind of like everything was green, right? Look at all the oil and gas stocks. Green all across the board there, right? Before we get into the bulk of this video, I'm going to make sure we shout out the partner of the channel, FTXUS. That will be first link in the description. Also be the pinned comment down there where you can get up to $100 in crypto right now. Sign up through the link and using referral code HOLYSMOKAS. Earn free crypto with every trade over $10. Also, FTX is getting into stocks. I'm trying to get them to give me access to their beta program. I can't wait to get access to that and kind of see what they're doing and how they're changing the game there. You can easily set it up on your phone to essentially, make recurring buys. So let's say you want to buy $10, $20 or whatever, of an asset every single week or every single day or whatever. You can easily set that up so you don't have to worry about any of that, and you can dollar cost average into the market if that's something you're looking to do. So pretty awesome deal. And FTXUS, once again, that'll be first link in the description. That'll also be pinned comment down there. Alrighty, guys. So obviously, economic recession, right? Everybody believes that we are either in an economic recession right now or we're going to be going into an economic recession. Everybody. I don't think I know anybody now that is that optimistic, to be honest, about the overall state of the economy currently or what we're about to go into now at this point in time. Almost every single person believes we're either in a recession or about to go into a recession. But the thing you got to ask yourself is there's levels of severity of a recession. And it's one thing to believe that we're either in recession or we're going to go into recession, but what's the severity of the recession? Are we talking about it's a small recession, a mid-recession, an elongated recession, a dramatic recession where, tons of companies go under and, unemployment goes to 10% plus? That's the thing you got to ask yourself, right? And if we think about what happened in the great financial crisis with that stock market collapse that happened, right, where the NASDAQ, the S&P 500, the Dow, they all fell 50% plus, right, 55% or so from peak to trough, which recently, as of a couple of weeks ago, the NASDAQ at its lows, it was down about 33.5% from peak. So, 33% is insane, okay? That's a big drop in an 8-month span. But that's not 50%. That's not 55%, right? So if you're assuming we're going to have a similar situation in the great financial crisis, you assume we're having, a lot further to fall. But remember this, okay? This is very important. The only reason the market fell that dramatically is because how dramatically bad that recession was, because of how bad unemployment went up, because of the financial devastation. Remember, we almost lost the entire financial system. AIG went under, Lehman Brothers went under, Salomon Brothers went under, Fannie Mae, Freddie Mac went under, right? There was a lot of talk that the big banks were going to go under, the biggest of the big banks. So there was a freak situation where literally it was almost the end of the entire financial system, and the Fed had to step in and basically save the day. And that changed a lot of things forever, right? That changed the way the stock market's valued forever, to be honest. It changed because now you almost have like this underlying thing that's almost willing to support by any means necessary, right? But we also saw unemployment go to around 10% or so. So because of the severity of that and because of how nasty it was, that's why the market continued to go down. That's why it just could not bounce. It could not bounce, and it just kept going down and down and down. So if we're going to talk about a stock market that goes down 50+%, we need that level. We need that level of recession. We need that level of drama in the market, okay, to get an S&P 500, a NASDAQ, everything across the board down 50% plus. If you don't get that, you can't have this sort of drop, essentially, okay? And so it's very important for everybody to understand that, okay? Now, I haven't shown these in a while. These are the newest numbers out of Yardini Research in terms of kind of forward Ps and many other metrics I want to show you here that are kind of going on in the market. Large caps right now are trading at 16.3 forward P. Now, forward P can change, right? Obviously, maybe the economy's stronger or weaker than we expect, and that could affect companies' earnings, right? What if a company has layoffs? What if they have one-time expenses? There's so many different things that can go into a company's earnings, share buybacks, right? That can change companies from, basically having a better EPS or a worse EPS over the next 12 months than expected. So, you gotta always take these things for what they are. They're not perfect. The forward P might be much higher than this in reality right now. The forward P might end up being much lower than that. We don't know, okay? That's all we do know is we don't know. We just have to assume like this is going to be somewhat in range, right? So 16.3, usually large caps are trading anywhere between 14 and 18. If you get under 14, you're usually very, very undervalued, and that's a great time where you get a lot of great opportunities in large caps, right? And you should be buying the large cap stocks. If you get over 18, that's usually a time where you got to say, I think it's maybe a time to cash some, or maybe cash up a little bit, or at least consider that, right? And that's just kind of what we've seen over time. If you look back at 2011, 2012, 2013, where forward Ps were trading at, it was a great time to be a large cap buyer, right? And obviously in the Great Recession, but let's just be honest, in the Great Recession, everything was a great opportunity to buy unless they went under, right? As long as they didn't go under in that situation, almost every single stock was a huge buy the dip opportunity at the end of 08, beginning of 09. So this is something to kind of keep in mind here. We're trading in a normal range now. That's good. We were trading ridiculously high for a while, and that was not healthy at all, and you're in for a tough sledding ahead if that ends up happening, okay? Now, mid caps and small caps are trading ridiculously cheap. Mid caps, you should usually expect them to trade a forward P of 15 to 17, right? That's a normal range for mid caps. We're at 11.8 right now. 11.8, okay? Small caps, you usually expect them to trade anywhere between about 15 and 18 roughly. We're at 11.3. And so this is why I continue to kind of, bang the drum in terms of small caps and mid caps, and where the money's got the best opportunity over the next few years to grow immensely, right? Large caps, I definitely see opportunities in large caps, and there's some large caps I've been buying recently. I bought a Meta recently, quite a bit of Meta actually. I bought some Amazon recently. I bought even some Shopify recently. I've even bought some Netflix recently. I bought some PayPal recently. There's been some stocks recently that I've been buying that are not mid caps and not small caps. But I just be honest, where am I putting most of my money? It's in the smalls and the mids, because that's where, in my opinion, the biggest opportunity to grow your money over the coming years is. And maybe I'm completely wrong on that, and I'll accept that. I just think that's, I don't expect us to trade at these sorts of ranges forever and ever, okay? I just think this is unsustainable, and I think we're eventually going to have a massive move up. No different than, obviously, this is completely unsustainable. Anytime you get so far out of range, you're in an unsustainable level, and it's just a matter of time before you flip. And eventually you're going to trade in your normal range. It's just a matter of time. It's is it 6 months it happens, 12 months, 18 months? I think that's the biggest question, right? You can only trade at ridiculous values, undervalued or overvalued, for so long. Then that ends, okay? Price to earnings growth, the PEG ratio. So in general, if you're looking at a stock, okay, and once again, all these things aren't perfect, right? You have to take it what it is, trailing Ps, forward Ps, things like that. The PEG ratio, price to earnings growth, usually if you're looking at a stock, you want to see a 1 or under a 1, okay? Once again, that doesn't work perfectly. Sometimes there's going to be bad stocks that are trading under a 1. And sometimes there's going to be stocks that are actually great companies and great stocks to buy, right? That are going to be trading at PEGs way above 1. But the traditional way of understanding PEG is under 1 usually means, undervalued essentially, okay? So PEG ratio right now is about 1.1 on S&P 500. Now, the important thing to remember about this is we're trading in a pretty historically low range. But when it comes to PEG ratio, it doesn't mean you can't trade there for a while. For the PEG ratio, price to earnings growth, we trade it, under 1.25 and honestly under 1 for a pretty significant amount of time, right? So 1.25 to 1.5 is a normal number. But look at this. We were under 1.25 for 3 years. From 07, 09, we were under 1.25, right? And so that's definitely something that could play out. Could we end up in a PEG ratio? Look at how long the PEG ratio has been under 1.25 already. We're already going on a year plus of a PEG ratio under 1.25. So to imagine another year or two of PEG ratio under 1.25 is not all around a possibility. It's definitely possible, okay? Doesn't mean it's going to happen. It's something that's out there, right? Trailing PE, if we take a peek at trailing for PE since I've been alive, this goes all the way back to the 30s, but, since I've been alive since 1989, right? Trailing PE, we're trading fairly cheap, okay? Obviously there's some time periods when we traded at insane trailing Ps, and this is obviously looking at the past 12 months of profitability for companies, right? And but the important thing to remember is even with trailing PE, we traded under this range for a few years before, right? Look at '09 through about 2015. All during that time, the trailing PE was basically, under where we are now. So it doesn't mean the trailing PE can't come down quite a bit from here, okay? And so that's something to kind of keep in mind there. When we're talking about trailing PE, right, it's always looking at the last 12 months. Well, imagine if companies aren't as profitable as a lot of people expect over the next 12 months, right? So that's a situation where there's not going to be as much earnings, right? And so stock prices have to come down to reflect a normal trailing PE. Miscellaneous, if we look at Russell 2000, if we look at S&P 600 small caps, S&P 600 small caps we already talked about, the Russell 2000 trading historically extremely cheap on a forward PE basis. We're at 18.5 right now for the Russell. I mean, look at where we're usually at for the Russell. I mean, usually you're like anywhere from 18 to like 26. Roughly, that's a normal range. I mean, you back this baby all the way up to 2,000, and that's like usually where we're trading at. Like anywhere, like when you go under 18, especially for Russell, you're trading insanely cheap. And you have very few time periods you ever get. Coming out of the great financial crisis, we were down there, right? During the great financial crisis, we were down there. But it's very rare. And so that's why I look at these Russell stocks. I look at a lot of these just small caps in general. I'm like, man, this is where, in my opinion, the opportunities are. And it doesn't mean, the deals are going to end this month or something like that. You could potentially get another 3 months, 6 months, 12 months to load up on these stocks. But I'm just like, if you just look at these things on a factual basis, on a historical norm, you don't usually get the sorts of opportunities for too long, right? Fear greed index. Let's talk about market psychology right now and kind of what's going on underlying, right? We've been in fear for a while in this market. A year ago, we were in fear. A week ago, we were in extreme fear. A month ago, we were in fear. And yesterday, we were in fear, right? So we've been flirting with fear or extreme fear on the fear and greed index for a while now, man. Obviously, the market's very fearful because of economic worries, because of recession worries, because of inflation being so high, the Fed continue to raise rates, companies' earnings being down, things like that, right? That's why we have that going on. Put-call ratio. So just keep this in mind. Like usually the higher this number is over time, it basically means that there's more people that are bearish on the market that want to bet against it, right? And they want to, usually like calls should always outnumber the amount of put options, which a call option essentially is a bet that a stock's going to go up. So there should always be more call options than put options because people are usually bullish on the market because they have a brain and they understand like the market goes up over time, right? So calls should always outnumber puts. But with that being said, right now, the market is very, very fearful. There's a lot of people that have been doing puts heavy this entire year, essentially, right? But specifically recently, like look at how insane the put to call ratio has gone recently. And at some points, I mean, we've gone more puts than calls. Look at that. That's extraordinary. When you go over a 1, basically there's more people doing put options than call options. That's insane, man. That's absolutely insane. The lows we reached, by the way, isn't this interesting? Right when the market peaked. Right when the market peaked, essentially, which was early November, that's when put-to-call ratio was the lowest, right? And ever since then, as the market tanked more and more, people piled more and more into put options and more into put options. And it's like, geez, man, all you guys are piling into put options left and right. And I understand it's been a profitable trade, especially, here, but as an investor, right, or even a trader, it's all about like where the market's going. Where's the market going over the next week, the next month, the next year? And especially for a lot of these people that do puts, because they're doing them very short-term basis. A lot of these folks that do puts, they might do it for a week out, a few trading days out, maybe a month out, something like that. So that's just very, very interesting to see that, right? I obviously show this almost on a weekly basis now. As AAII investor sentiment, we're incredibly bearish on the market in terms of the investment community. This is, how bearish or bullish people are for the next 6 months in the stock market. Overwhelming amount of people are bearish on the market. A very small number of people are bullish on the market over the next 6 months. It's where we are, man. That's where we are. People just don't believe in the market at all over the next 6 months. And, and I've showed this in the past, but essentially, when it comes to that ratio, every single time people get overwhelmingly bearish on the market and very few are bullish, you almost usually within 3 months get a crazy move upward in the market. I look back at data, and every single time I could find like less than 20% of investors were bullish on the market, and 50-60% were bearish on the market every single time, usually within 3 months. Sometimes even within a few trading days, you get this insane upward move. So I'm not saying that's going to happen this time. A lot of people look at this and they'll say, Well, in those past times, the Fed maybe pivoted, right? They helped out the market, and that's what got us out of that dramatic drop. If it wasn't for that, those people would have been right to be bearish, right? And I say fair play to that. But what I want to show you here, which I think is very, very important, is what happens if this happens over the next 4 months? And I think this is a very realistic scenario what's going to play out over the next 4 months. There's going to be 2 quarters announced in the next 4 months. We're about to get into Q2 earnings season right now, and then 3 months after that, we're going to have the Q3 number. So over the next 4 months, we're going to have 2 earnings seasons in here, okay? What if those numbers are weak? I think it's a very much a possibility that those numbers are not strong for any companies. What happens if there's more layoffs? I think that's a real possibility from companies, more layoffs. What if real estate numbers come in and they're a disaster, as I think they're going to be over the next 4 months? What if inflation rate of growth starts to decline and we go from 8.6% inflation to all of a sudden 7.6%, to all of a sudden 6.6%, to all of a sudden 5.6%, right? I think that's a real possibility, especially if we can talk about oil prices going down and gas prices at the pump starting to go down in future months. What happens if investor confidence and consumer confidence, which have been historically extremely low recently, what happens if those remain low for the next 4 months, right? Well, at that point, we could end up in a flip situation with the Fed where they flip so fast. I mean, they flip faster than you could say Ohio State, right? And they could be in a situation where all of a sudden they start talking about, we're not going to raise rates anymore. And actually, we're thinking about potentially cutting rates in 23. That could be a real situation that ends up playing out. And believe me, 6 months to 12 months in Fed terms is like all the time in the world, right? I mean, I've watched the Fed in a 6 to 12 month span go from, not raising rates at all, we're not going to do that, pumping money out there, to obviously going completely against it. So to imagine them over the next 4 or 5 months going from, we're raising, to also go to a situation where they're like, no, we're actually going to look at potentially cutting. That's not, in my opinion, that's not out of the realm of possibility at all, especially if what I just showed you there ends up playing out. And I think that's a very realistic possibility over the next 4 months. We'll see what plays out. I just think that's very much a realistic possibility. So, in my opinion, the market's a little bit in no man's land right now, is looking for these earnings, right? It wants to hear the bank earnings next week. That's going to matter. The next inflation numbers, when those come out, that's going to matter. And then obviously every quarter we go from there is going to matter in a big way. And every month as we go along with this inflation numbers. Inflation numbers, in my opinion, are the most important thing for the stock market overall. I don't think there's anything more important. I think it's even more important than earnings right now, which is saying a whole lot, okay? So anyways, guys, I hope you enjoyed this. As always, much love. I appreciate you joining me. And Mr. Noisy. Yeah, you Mr. Noisy. Mr. Noisy made a guest appearance. All right, guys, much love and have a great day.